So let's start with Glide, this charity. Why was this so important to your late wife, Susie?
Well, she saw an individual, Cecil Williams, who had a remarkable interest in helping anyone, the people that society had given up on. And she worked with him some. She worked in the kitchens and volunteer. And she kept telling me about him. And I think I was a little suspicious. I'm suspicious of all that sort of thing. And then I went and saw the operation myself, got to know Cecil, and really watched him transform the lives of thousands and thousands of people. And I think maybe Susie got the idea of this auction or something. And then eBay has been terrific in terms of really broadening the bidding audience. And so now it's a very pleasant way. I mean, very nice people. I have a great lunch, and Glide can help more people.
It's a great cause. It's great that you're involved in it. You're in the news. Berkshire Hathaway is in the news again because you just exercised those warrants for Bank of America Merrill Lynch. Tell us about that. Obviously, it's a great deal for you. You made a lot of money off the stock, but also a fair amount of the dividends over the years. You're getting 6% interest on the dividends. Why did you exercise, and how does it fit to your overall investment philosophy?
Well, we exercised because the dividend we will get now, the Bank of America has increased their common stock dividend, and now we will get, well, what, $280 and we will be getting $30+ million more annually from owning the common and the preferred. And we had announced that if the dividend on the common got to where it exceeded the dividend on the preferred, we'd exercise our warrants. So it was fairly automatic, and now we'll hold the common.
But is this consistent with your overall philosophy of finding a really good business over a long period of time, management you really believe in, and investing in it, or is this more just the deal?
No, it is management we believe in and a business I like. I mean, I followed the Bank of America since I read a book on it 55 or 60 years ago called The Biography of a Bank, and it's got an amazing history. And they got in trouble. They made acquisitions that, particularly countrywide, that caused them a lot of trouble. And so they were in significant trouble. But that's like a great athlete being in the hospital for an accident. I mean, it takes them out of action for a little while, but you got to get them back in shape. And I came in at a time when people were particularly critical of the institution and to some extent the management, and I believe they were wrong. So I actually got the idea in the bathtub one day in 2011, and when I got the office, I called Brian Moynihan, who I'd never met before, the CEO, and we made a deal very quickly.
Bank of America, more than most banks, is really dependent upon the rates. The rates go up, they make more money because they're really in the retail consumer banking business. Is your investment here saying something about where you think that is going?
Not really. I mean, although you're right about what you say, but they're doing fine currently. They had a lot of troubles from the past, and Brian went through those one by one, and some of them were very expensive to solve, some of them were very time-consuming, but I knew he'd get the job done, and it took years. I mean, it's a very tough job, but they are a retail bank, compared to a J.P. Morgan or something, it's quite an institution, and it will do better earnings-wise if rates do move up. But it's doing pretty well now, and it's been doing better quarter by quarter.
So you own, I think, something like 7% of the shares now, common stock, right? Take us out 3 years, 5 years. Is it more likely to be 10% or more likely to be 3%?
Well, I think it's very likely that we don't sell any, and they have had a history of repurchasing their shares. So our 7% or whatever the number may be now, might be a touch less than that, that it will go up if they repurchase more shares than they issue, which I think will be the case. So I would guess our percentage interest would be higher 3 years from now, but that would be because of their repurchases.
So let me spend just a moment on what in some ways appears a similar deal to inject capital into Home Capital Group up in Canada, a home lender, right? And now we have institutional shareholder services coming out and opposing your administering the second tranche. Is that discouraging you? Might you walk away from this?
No, not really. I mean, we knew it'd be subject to vote of the shareholders, and if the shareholders vote it, we buy it, and if the shareholders don't vote it, we don't buy it. I mean, we knew that could go either way. We bought a piece of it going in, which is a little less than 20% of the, and we assisted them with a loan backstop that was cheaper than the one they had. So we'd like to buy the stock, But if they vote it down, if the shareholders vote it down, we'll be fine.
So continuing on with your investment philosophy, let's talk about IBM for a moment.
Yeah.
And you've said that it was a mistake, and we all make mistakes.
It was my mistake.
I make my fair share. But let's go over what you learned from that mistake. I mean, you, as I say, generally you find businesses you believe in over the long term and management you believe in. What went wrong?
Well, I've made lots of mistakes, Dave. That's part of the game. I mean, there is no way in the investment business, if somebody says to you they never made a mistake, check them out. But that was a fairly large commitment. And I would say that the competition, what's really fascinating to me actually is what Amazon did with the cloud. I mean, here is a company that you don't even think of as being in that business 6 or 7 years ago. And Jeff Bezos has really taken something, you wouldn't have thought they'd be doing that. And from a standing start, and he has even said on Charlie Rose, he was amazed at how much runway he was given. But here are a bunch of very smart people in the tech industry around him, and not just IBM, but Microsoft, Google, you name it. I mean, the people. And they all let them have a big lead, and you don't want to let a smart fellow have a big lead.
But what does that tell you about the tech sector in general when it comes to investing? Because it seems that tech may be more susceptible to massive disruption than other run-of-the-mill businesses.
Sure. I mean, we've got a railroad, and we're not going to wake up tomorrow and find 4 new railroads are competing with us or something of the sort. And in the tech business, you have a group of very smart people who have access to resources, and they're all the time trying to figure out how to bring out a better product than you have. I mean, here, I may be carrying this around, but this was the hottest item around, I'm sure, at one time. But
well, you've got a big investment in Apple. They're coming out with a new iPhone. You might want to think about it this fall.
Yeah, well, Tim Cook's reminded me of that a few times.
So talk about your investment at this point. You have, last time I checked, something close to $100 billion of cash and cash equivalents waiting to be invested.
Yeah.
You might not want to invest all of that, but you'd like to invest a fair chunk of it.
I'd like to invest all but $20 billion. I always like to keep $20 billion around.
What does it tell us that Warren Buffett, Charlie Munger, and Berkshire Hathaway can't find sensible investments to make in this climate of that $80 billion?
It tells us the stocks aren't as cheap as they've been most of the time. Yeah, it was shooting fish in a barrel in late 2008 and 2009, and stocks have been steadily going up, pretty steadily going up now for. Well, March of 2009 was the low, early in March. So it's 8+ years, and stocks aren't going to earn much more. They're not going to earn more just because you pay more for them. So they have gotten less attractive as they've gone along. They're still very attractive compared to bonds. I mean, if you look at the 10-year government at 2.15, that means you're paying 45 times earnings when you buy that bond. And the earnings aren't going to go up. I mean, if you put $100,000 in that 10-year bond, you're paying 45 times earnings for a form of investment where the earnings can't go up. Well, stocks still look attractive compared to that, but they don't look as attractive nearly as much as they used to. And of course, if interest rates go up, then the comparison becomes far less dramatic.
Well, and I wonder if there isn't a direct connection between those two things.
Oh, there is a connection.
And how much of it is because the central banks, not just the Fed, but also the ECB and the BOJ, particularly the Bank of Japan, have really injected trillions of dollars and euros and yen into the system, which has driven asset prices up?
It drives them up. There's no question. They probably wanted to drive them up too. But the interest rates are to stock prices what gravity is to matter. I mean, if interest rates were nothing, and they were going to be nothing forever, you'd be buying stuff that would yield you 1% or 2%. You might be buying real estate. You might be buying stocks. If interest rates are, on the short rate, 21% like they were in 1982 under Volcker, you could look at a stock at 6 times earnings and you could say, well, that's really isn't that attractive. So interest rates, I mean, that's what drives valuations, and we've had these very, very low interest rates now for sometime a lot longer than I thought we would have them, and probably a lot longer than most people thought we'd have them.
And at the same time, we have the Federal Reserve certainly signaling they're going to start coming off. They're going to start letting their balance sheet roll off some. We have even the ECB saying maybe they'll cut back on quantitative easing. What effect might that have on stock prices and other asset valuations?
Well, I think they'll be pretty careful about how they do it. The Federal Reserve has about $4.5 trillion in assets now, and it's as I remember, it's $1.7 trillion or $1.8 trillion in mortgages and the balance in U.S. governments, and they can just let it. They can do it by maturity, but if they were to go back to the trillion or $1.5 trillion, that would be $3 trillion of maturing securities that they would not be taking up their piece on, and somebody else would have to do it. So they'll be very careful about how they do it.
So has quantitative easing worked? I mean, certainly it saved us. At the same time, it seems like there was sort of a trickle-down theory that if we increased asset prices and income to people making money off of assets, that somehow it would get the economy going, and yet the average hourly wage is not going up as fast.
No, but it did wonders for us coming out of 2008. Not without it, you know, if we'd gone back to the economics of 100 years ago, you know, and the Fed had not been there to ease, and we'd have had a far different recovery. No, I think the Fed has overwhelmingly done the right thing. Now, we've never gone through a period like this, and how it will all work out, you know, we will find out. I think they'll be intelligent about it, but they've never played this game yet either.
So one issue is the tricky transition, which, as you say, we've never seen before. This kind of massive monetary easing.
Yeah.
At the same time, there's a question of whether monetary policy needs to hand off to fiscal policy. And when Donald Trump was elected president, there was a lot of hopes about tax reform, about infrastructure spending. How critical is that to really robust growth in the underlying economy? I
think our economy will grow. What really drives the economy is the market system, and it's the people like the Jeff Bezoses of the world, and we haven't had good productivity gains lately, but if productivity per capita goes up, the country's wealthier. I mean, it's that simple. So productivity gains and innovation are the key, and they largely will come from the private sector, and the private sector is plenty incentivized to do that sort of thing now, and they've got the resources.
So and typically productivity is tied to capital investment in innovation.
Yeah. Although it's, you know, this phone is pulled out. That's a form of productivity, and that can be R&D and all of that, but it isn't big steel mills or big oil refineries. I mean, wealth 100 years ago with the Rockefellers and the Carnegies, it involved huge capital investment. If you take the 5 largest companies in market cap in the S&P now, they're 10% of the overall S&P. They're all tech companies. You could run all 5 of those companies with no equity capital. So you've got 10% of the S&P with 5 companies that are making our lives better, but they don't require any equity capital.
Does that suggest maybe we're measuring productivity the wrong way around? Because when we started the measurement, we didn't have things like that little cell phone in your pocket.
Well, that's always a question. I mean, the fact that I can write my annual report a lot easier now, because if I want to check a quotation or a fact, it takes me 15 seconds on search, whereas I used to have to go to a library or right away for, you know, that's made me enormously more productive. Not that anybody necessarily wants the product, but I can get things done a lot faster. Does that get into the GDP figures? I'm not sure. I mean, you know, I suppose some economists would say they've really got a way of correcting for all that, but I really think that there have been a lot of improvements in lives. You know, I can play a bridge game now, you know, by getting 3 people together on the internet in 15 seconds or 30 seconds. I used to have to make calls and get my buddies to drive over and all kinds of things. So our lives have gotten a lot better in general than actually I think the GDP figures show.
Well, it's interesting you say that. You've said, I've heard you say before, that if you're born in the United States today, you've won the lottery right there.
Absolutely.
Right there. At the same time, as you look around the country, there seem to be a lot of people who don't believe that, who don't feel that they're participating in it, and they're angry and they're hurt and they're scared. Why is that?
And I don't blame them. I don't blame them, because they see the Forbes 400 that had 92 billion of aggregate wealth in 1982 that now have 2.4 trillion. So they've seen that top 400. It's a changing group, but it represents the people at the top. They've seen them go up 25 for 1 in wealth since 1982. And you can see it in the income tax figures and a whole bunch of places. So the gain in wealth in this country has disproportionately gone to the super rich, and a lot of people have gotten left behind, which should not be the case in a country that our country has $57,000 or $58,000 of GDP per capita. You know, that is a lot of money per capita, but the distribution has gotten more pushed toward the top in recent decades. It's not because those people are evil, it's just because of the natural function of the marketplace, but it's up to the government actually to do something about that.
Okay, so finally, it's your birthday. Happy birthday, Warren.
Thank you.
As you begin your 88th year, this is the question I have for you. You and I both knew Dan Burke very well.
Absolutely.
I worked for him. He was my boss. You were our major shareholder at Cap Cities ABC. We used to go to those Phoenix management retreats.
Yeah.
And at one of them that you were there for, Dan Burke came up, I don't know if you remember it, and he said to the entire management of Cap Cities ABC, there's only one thing I'm truly afraid of, and that is failing as a parent for lack of trying, which stuck with me.
Yeah.
It was very powerful. As you enter your 88th year, what is the one thing Warren Buffett's afraid of? Not necessarily for Warren Buffett, but for his children, his grandchildren, for our society. What's the one thing that you genuinely fear?
I would say that if you really talk broadly, it's weapons of mass destruction. I mean, we now have individuals, we have groups, we have countries that would like to, in just a few cases maybe in countries, but like to kill as many Americans or maybe some other countries' inhabitants. And they've now got weapons that they wouldn't have dreamt of 100 years ago. I mean, for a long time, if you didn't like your neighbor and he was in the other cave, you threw a rock at him or something. But now you've got weapons that can kill millions and millions and millions of people, and you've got them in some unstable hands in certain cases. And it goes beyond that to cyber. It goes beyond that. I mean, you know, you had the fellow with the anthrax, and you know, and it might have been twisted a little different way. He might have figured out a way to distribute it far greater. We live in a dangerous world that way. It's the only real problem of humankind. I mean, we will have a more prosperous world. We'll have a more prosperous United States. We'll have healthier people. We'll have better educated people. Everything's going our direction, except that huge cloud out there. And I don't have any great answers for it. That's why it's a huge cloud.
But does that put North Korea at the top of your list?
It's got to be awfully close to the top of the list. I mean, there could be something going on I don't know anything about beyond that. But if you have a small, relatively poor country that's spending a significant part of its GDP trying to figure out how to get an ICBM that can hit the west coast of the United States, I mean, there is something going on in somebody's mind that I don't like.